Have you ever just stared at a pre-market chart, watching those ticks move up and down, and thought to yourself, how do I actually know if the market's going to trend today or if it's just going to chop around and go nowhere, right? It is literally the core pain point for every single intraday trader out there. The daily market, well, it can feel like pure, unpredictable chaos. But what if I told you there's an actual mathematical way to bring order to all that chaos before the opening bell even rings? Welcome to this explainer. Today, we're unlocking something I really love to call the trader's compass. We're going to master pivot points and an incredibly powerful evolution of them known as the CPR. So if you've been relying on, say, gut feelings to guess market direction, get ready. Because today, we're replacing all that guesswork with a highly structured, totally objective framework. Okay, let's dive right into this. Here's our agenda for today. We'll start with the trader's compass, move into calculating the pivot, check out the central pivot range, compare narrow versus wide CPRs, break down some high-probability trading strategies, and finally, building your trading system. Section 1, the trader's compass. So if you're going to navigate the incredibly chaotic sea of the stock market, you absolutely need a reliable navigational aid. And that tool is the pivot point. A pivot point is basically a median line, calculated using data from the previous trading session. Specifically, we're talking about the open, high, low, and close levels. Honestly, the easiest way to visualize this is to think of it as a borderline between bulls and bears. It's that simple. Above the line, the bulls are in control. Sentiment is positive. Below the line, the bears have taken over. Now, just like a physical compass has different dials for different uses, there are actually multiple ways to calculate pivot points depending on your own individual risk tolerance and how often you trade. You've got the classic pivot points, which give a really great balanced view. There's Woody's, which heavily weights the closing price. The Camarilla method produces a ton of different levels, which is fantastic for active day traders who want quick profits. Fibonacci pivots integrate those classic retracement levels we all know. And finally, the central pivot range, which completely upgrades a single line into a fully defined zone of support or resistance. Section 2. Calculating the pivot. Let's look at the math behind the magic here, because I promise you this is grounded in objective, cold, hard data, not intuition. Take a look at this classic formula table. I know, it looks like a lot of letters, but it is beautifully simple. Actually, to find the main pivot point for today, you literally just add yesterday's high, low, and close, and divide the whole thing by 3. That's it. You're just taking the average of yesterday's price action to build your primary market sentiment indicator for today. And from there, you use that main pivot number to calculate your support and resistance levels for the day. It's just a brilliant, objective way to structure things. Section 3. The central pivot range. Now, let's shift our focus to a really effective evolution of that standard pivot point. Instead of relying on a single kind of fragile line on your chart, the CPR forms a sturdy 3-price level range. You've got the central pivot right in the middle, calculated just like the classic method we talked about. But then you add a bottom central line and a top central line. What this does is give you a much more defined, robust area of support or resistance. Think of it like it's not just a fence anymore, it's a fortress wall. And I want to share a staggering statistic from our sources, 40%. There is a 40% chance that a stock will not break a specific type of CPR range today if it failed to reach it yesterday. Let that sink in for a second. That specific range, it's called a virgin CPR. A virgin CPR forms when the price action completely avoids crossing any of the CPR lines during the previous trading day. So why does this matter to us? Well, because if yesterday's price never touched the CPR, that level remains virgin, and it offers a massive, statistically proven edge in predicting exactly where the market is going to stall or bounce today. Section 4. Narrow versus wide CPR. The width of the CPR range is hands down your ultimate secret weapon for forecasting how the market's going to behave before it even opens. And this brilliantly illustrates the whole dynamic. When those 3 lines of the CPR are tightly packed together, a narrow CPR, it means price was heavily compressed the day before. It's like a coiled spring. And what happens after compression? Boom, an explosion. A narrow CPR signals high volatility and an expected trending day. But on the flip side, a wide CPR where the lines are really far apart, well, that means the market had a massive move yesterday and is basically taking a breather today. So for those days, you should expect range-bound, sideways, choppy action. Let's bring this theory to life with some real market data. Look at this case study on Infosys from our sources. On March 19, 2026, the CPR was extremely narrow, And sure enough, what happened? The market opened with a gap down and heavily trended lower all day long. Then, the very next day, March 20th, the CPR was wide. The market took a breather, went completely sideways, tested the pivot support at 1229, and reversed right off of it. That is 2 back-to-back days where the physical structure of the CPR correctly predicted the entire personality of the trading session. Section 5. High Probability Trading Strategies. So, how do we actually make money with this? Let's put boots on the ground here. Our first playbook is the breakout strategy. Step 1. You wake up, look at your chart, and identify a narrow CPR, so you immediately know a trend is likely today. Step 2. You patiently wait for the price to aggressively cross resistance 1 or support 1, and make sure it has significant volume behind it. Step 3. Confirm this strength using a momentum indicator like the MACD, just so you don't fall for a fake out. And Step 4. Adopt the ride the trend mindset. You hold that trade and let the momentum carry you. But what if you wake up and see a wide CPR? Well, then you switch gears to the range or bounce strategy. Wide CPR days offer highly structured, risk-defined opportunities. You basically initiate sales when the price gets near resistance 1, or you buy when it dips down to support 1. You place a strict stop loss just outside those levels, and your profit target is a simple return to the central pivot point. You're just playing ping pong between the borders until the market conditions shift. Now, what's really interesting about this setup is that the CPR isn't just for fast-paced day traders. Swing traders can use this too, just by zooming out. If you want a high-probability long setup, you look for conditions where both your hourly and daily charts are trading above the weekly and monthly CPR levels. If everything is aligned above those higher time frame pivots, your directional bias is incredibly strong. But if your time frames are giving mixed signals, like say the daily is above the monthly but the hourly is below the weekly, that's a low probability setup. You should either size your position way down or just walk away entirely. Section 6. Building your trading system. So the CPR is an amazing foundation, right? But a foundation isn't a whole house. You need a complete, holistic system. I absolutely love this image from the source text. On the right, you've got a trading algorithm. Algorithms execute flawlessly because, well, they don't feel fear or greed. But on the left, that's us, the human trader. We are deeply emotional creatures. And in the market, letting your emotions run wild will literally wipe out your account. We desperately need objective tools like the CPR to force us to stay disciplined and, frankly, execute a bit more like the robot. So the crucial point here is this. Pivot points are not absolute, guaranteed certainties. No indicator is. But they become wildly powerful when you use indicator synergy. Combine your CPR levels with the RSI to spot divergences or overbought conditions. Cross-check your pivot bounces with moving averages for trend continuation. Verify those breakouts using volume indicators. By layering the CPR with these other tools, you build an incredibly robust, data-driven framework that filters out all the noise. I want to highlight this quote directly from the source material because it really sums up everything beautifully. Consistent intraday trading depends less on prediction and more on structured decision-making. Look, stop trying to be a fortune teller. The CPR doesn't predict the future. It gives you the structure to react smartly to whatever the market throws at you, rather than just guessing blindly. And that brings us to the end of our explainer. But I want to leave you with one final question to consider before your next trading session. Will you continue letting the random chaos of the market dictate your trades and your emotions? Or will you step up, apply the CPR, and actually use the compass to confidently navigate the chaos? The choice is entirely yours. Thanks so much for joining me on this deep dive, and hey, happy trading!